It would help if I unmuted the microphone. Anyway, welcome back, everybody. In about 60 seconds, we are going to be getting the FOMC and their minutes from the September meeting. Now, what's interesting about this is, well, first of all, like bonds are, selling off. We've had this issue since the 50 basis point cut, which was mind-blowing to me. It's because we got a hawkish Powell, right? We've been unpricing future cuts. Some people are like, we're only going to get one more cut this year. There's only an 80% chance that we're actually going to get a cut at all in the next meeting, which is crazy. So anyway, let's see if this shifts the balance at all on those labor risks. That's what we're going to be paying attention to. So we're going to get this all up. And I'm going to read you the notes first as they come out. So they'll be out in just a second, and I'm going to read them off as they come in. Here we go. Come on, baby, come on. Federal Reserve, not yet. Where is it? Where is it? Not out yet, not out yet. Apparently they got it before me. All right, fine then.
Welcome to Power Lunch. The minutes of the Fed September meeting show quite a bit of disagreement over the issue of 25 or 50, the 50 basis point rate cut that they ultimately agreed on. I'll get to that in a second. Let me show you first where they agreed. All participants agreed it was appropriate to ease. They judged it was appropriate to continue the process of reducing the funds rate. And if the economy evolved as expected, they said it was appropriate to move to a more neutral policy stance. Most saw policy as restrictive. They disagreed, however, over how restrictive to be. A substantial majority, it says, supported lowering the funds rate by 50 basis points. However, it did not say how many or what, but a substantial majority wanted the 50. Recalibrating policy, they said, would bring it into better alignment with the inflation and labor market.
All the same so far.
Some, however, would have preferred 25, and a few others said they could have supported 25. So some plus a few, we don't know how many that is, but it was more than just the one dissent is what we're learning that supported just 25. Several noted that 25 would be in line with a gradual path of policy normalization. A few noted 25 would be more predictable. Now, on the economy, some worried there was differences here that probably reflected the differences over 25 or 50. Some worried that the easing in the labor market could transition, quote, to a more serious deterioration. Yep. Many saw the economy growing at trend over the next few years, and almost all saw diminished risk to inflation and downside risk to employment. Several worried about consumer spending from cooling of the labor market. Some were concerned the pace of hiring was not strong enough to keep the unemployment rate from rising. So this was all before that recent September employment report that we got in October. But so there was a lot of concern about the job market. Further labor market cooling was not needed to get to the 2% inflation target. And a couple people were concerned, though, about upside inflation risk from geopolitical events, very much the way we heard this morning from Dallas Fed President Lori Logan. So, guys, back to you. I think that.
Okay, let's get actually into the meeting minutes here. We're going to start with unemployment because that's the most important part. Staff review of the economic situation. The labor market continued to be tight with unemployment rate low and job gains slowing but remaining strong. Consumer price inflation was still elevated. The imbalance between labor and supply appeared to be easing. The non-farm payroll employment levels increased at a slower pace over July and August than in the second quarter. Private job opening rates and quits rates moved down further. Those are some we've been watching. Unemployment rate stood at 3.8. Now it's like 4.1. The unemployment rate, okay, these are specific sectors. That's fine. ECI wasn't an issue. They generally don't see ECI, like the cost index for employment, as an issue, and they don't see it as inflationary either. Consumer price inflation remained elevated but continued to show signs of a slowing. This is good. This is what you want. This is fantastic. Okay, let's get some more reads on employment here. Okay, the unemployment rate was projected to remain roughly flat through 2026 as upward pressure from below potential output was offset by downward pressure from further improvements in labor market functioning. Yeah, dream on right here. Dream on. Companies want EPS. So as you get below trend growth, you lay off. That's a pipe dream right there. Continue to see uncertainty. That's fine. Let's see here. The unemployment rate inflation for 23 to 26 over the long run. Participants submitted their projections. We've already gone through all that. Okay, some participants observed that payroll growth remained strong but had slowed in recent months. Yeah, that's pretty consistent with what we've seen. To a pace closer to that, consistent with maintaining a constant unemployment rate over time. Okay. Most participants commented that the pace of nominal wage increases had moderated. That's actually a good thing. Even though they don't really see it as too inflationary if you do have wages moving up. Powell himself says this. Of course, it could be an issue if you have a spiral, but there's no real sign of a wage price spiral. They noted, however, that nominal wages were still rising above levels generally considered to be, consistent with 2% inflation, although inflation is still falling, so that's not too big of a deal. Then, let's see here. I just want to make sure the volume's okay for it. Yeah, volume should be okay for y'all. Okay, good. All right, keep going here. Then we go risk to economic activity, upside risk to the unemployment rate. Such risks include larger than anticipated lagged macro economic effects from the tightening of financial conditions, the effect of strikes, slowing global growth, continued weakness in commercial real estate. Yes. Overemployment. They also, yeah, that's actually an interesting. Did we see overemployment? No, we didn't see overemployment. Okay, over-tightening. Inflation remained elevated. They concurred that job gains had slowed in recent months, but remained strong. Okay, fine. They agreed they would continue to assess additional information. So far, let's see here. So far, nothing new here. Unemployment rate had remained low. Okay, that's fine. So that's on employment. That's when I search employment. Let me try jobs. Most participants remarked that a range of indicators of labor market demand were easing and could be seen in declining job openings. Yes, and a narrowing of the jobs to worker gap, lower quit rates, that's true, and a reduction of hours. These are all really bad, by the way, to levels at or below those seen in the pandemic. This is bad. This is a sign that the Fed is paying attention to what they should be. This right here is sad face. That's how you get a recession. And recessions do not come slowly. It's like at first there's no recession, and then all of a sudden, oh my God, we're in a recession. I shouldn't say, oh my God, sorry about that. I got to work on that. But anyway, however, several participants noted that labor markets remained very tight in some sectors of the economy, such as healthcare and education. Many participants also observed that measures of the labor supply had moved up. Some participants commented participation rate, that's fine. For women has gone, okay, fine. That's actually what Jay Powell talked about in the opening as well. It's almost like he was picking up what some other folks were putting down, so to speak. Okay, how about, let's go with wages. I don't think we're really seeing much here on wages. Nominal wages still above levels of 2%. I mean, it's worth noting that as a risk. It's not a big risk, but it's worth noting that. Then we've got geopol. No, nothing geopolitical. What about election? Is that word in here? No. What about recession? No, there's no word recession. What about GDP? Okay. Solid pace in the third quarter. Available indicators suggest that real GDP was expanding at a solid pace. Let's see. Rising. Real good increase after falling in July. That's fine. Forward economic growth fell, weighed down by China. And then, of course, China started stimulating. Staff assumed GDP growth for the rest of the year would be damped by the auto workers' strike, with the effects unwound by a small boost to GDP next year. Okay. Size of strikes are obviously, TBD. Okay, let's see here. Good. I mean, there's nothing scary in this. Participants continue to review a period of below-trend growth in real GDP and some softening of the labor market as likely to bring aggregate demand and supply into better balance. It's not ideal. I mean, this is actually very odd to me that you had to put this note in here. Like, this is very, very odd. I'm putting a WTF there. Now, I'm going to tell you why I'm putting a WTF there. Jay Powell literally told us. Remember what he told us? Jay Powell, we seek no further cooling of the labor market, right? That was Jackson Hole. Now, what do you have here? Now, they say some softening in labor market conditions as likely to be needed to bring aggregate demand and aggregate supply into better balance. Okay, that could be a revision, could have been revised in due to last jobs report. Maybe. But that's odd to me. Like, this is a flip-flop right here. I don't really like that. That's bad because now you're toying with recession more so. Now you're toying with recession. Okay. In the discussion of the household sector, participants observed that aggregate consumer spending had continued to exhibit considerable strength. However, participants noted that the finances of some households were coming under pressure with high inflation. We know that. Declining savings, increased reliance on financing expenditures. Fine. Increased cost pressures. Several participants committed that a government shutdown. No, we're not having a government shutdown, so it doesn't matter. What's this? Lags. Consideration of the cumulative tightening and the lags. Almost all participants judged it appropriate to maintain target. What? Oh my god. These are old. I'm such a dumbass. How did I get old minutes? Kevin. Yeah, now y'all are seeing it. Oh. How did that happen? Alright, well, that's embarrassing. Alright, well, whatever. Let's go get the other ones. Well, we're gonna get to see some change over time. I'm like, this is weird. Like, this isn't lining up. Okay. Here's the correct September one. Jeez, Kevin. Okay, let's get the right one in. Well, whatever. Mistakes have been made. There it is, September 18th. All right, well, you know what? We'll have a cool compare and contrast. I thought some of those things were just odd. And then I see maintain, and I'm like, huh? That ain't right. All right, no problem. So it took an extra 5 minutes, big deal. September 2024. Always check the title back. Always check the title first. Okay, yeah, now this should be a lot more consistent. Now, honestly, is probably actually a good thing because we're going to get to see the difference here. So, let's go with, what? Oh, come on. That's just, dang it. Why is this impossible today? Fed FOMC, September. Because are they just not on the... There we go. Oh my gosh. It just took forever to pop up. Okay. Stand by. Loser. It's funny too, because I have to go. But this is more important. Alright. Okay. Delete. Come on, dude. Alright, here we go. Alright. Labor. Okay, now this will be really interesting because now we have last year in our minds. Now we're going to compare. Governor Bowman preferred lowering the range by 25, citing a labor market that is near full employment and solid underlying growth. She expressed her concern that this could be seen as a premature declaration of victory on the dual mandate. Oh, that's interesting. It's interesting to see this dissension. Members agreed that their assessments would take into account a wide range of possibilities. That's fine. Do this here really quick. Okay. There we go. Okay. Also emphasized that such a move would strengthen the economy. I don't think so. A 50 basis point reduction. Better alignment with inflation indicators and the labor market. Sustain economic strength by continuing to promote progress on inflation and the balance of risk. That's fair. That's good. I should think they're doing a good job with this. did not perceive the risks of a significant weakening in the labor market conditions. A couple of participants did not see risks of further weakening. How? Blind. Okay, several participants cited the risks of sharper than expected slowing in consumer spending. Yeah. Continuing to strain budgets of low to moderate income households. Yes. There's geopolitics, finally. Upside risk to inflation because of geopolitics. Makes sense. It wasn't in the last September. That was before the Israel attack, that horrific attack. With regard to the labor market outlook, participants noted that further cooling did not appear to be needed. Good. So you should cut more. Participants indicated their baseline economic outlooks for recalibration. Labor market would remain solid. Good luck. Participants agree that labor market conditions were at or close to consistent with basically where they want to be. Labor market developments had been challenging with increased immigration, revisions to payroll data, and possible changes in the underlying growth rate. Right. I mean, in fairness, it is cloudy. It's basically you're flying with cloudy data, right? Flying the clouds with vision only. That's kind of what it feels like. You know, no instruments here to guide you. Participants noted that labor market conditions remain solid. Some participants stressed that rather than using layoffs to lower demand for labor, businesses had instead taking to posting fewer job openings, reducing hours, or making use of attrition. Correct. That's actually a really big danger because as soon as you lay off people, you signal to markets that your business is not doing well. So you generally don't want to signal layoffs. That's why you're getting a lot of this sort of quiet quitting. Supply and demand for labor in balance. Some participants suggested that a more rapid deflationary trend. Oh, whoa. Several participants observed that with supply and demand and labor market roughly in balance, wage increases were unlikely to be a source of general inflation. There you go. That's what I was talking about in the last sheet I was looking at. With regard to housing services prices, some suggested that a more rapid deflationary trend might fairly soon emerge, reflecting the slower pace of rent increases. Yes. To that I say yes. These, okay, that's fine. Various factors putting downward pressure on employment. Waning pricing power. Yes. Yes, this is what I've been talking about. Yes, exactly. Waning pricing power. Several noted nominal wage growth was continuing to slow. A few participants cited signs that this could further decline, which would be bad. Disinflationary process would be assisted by slower nominal wage growth. True, but there's a balance there because you don't want to go into recession. Staff noted that economic forecasts were tilted to the downside. Labor market conditions could point to greater slowing in demand than expected. Oh, this is actually a warning. My gosh, this is actually turning dovish here. The risk that inflation forecast was seen as balanced, further deflation. The staff continued to view uncertainty around the baseline, of course. Both total PC were expected to decline further, and demand and product markets continue to move in better balance. That's fine. Supply and demand and labor markets were forecast to be more balanced. Fine. Largely in response to softer than expected labor market indicators. Real GDP was changed little, though the unemployment rate was expected to be a little higher than previously forecast. Unemployment rate is expected to be flat between 25 and 27. Well, good luck holding it steady there. This is actually very interesting. Now we're really getting into like the weeds here. Recent data suggested labor market conditions had eased further but remained solid. Labor force participation rate picked up. Measures for nominal labor compensation continue to decelerate. Yep. Okay, interesting. Any recession word here? No recession word. Election is not used as well either. What about political? Political is used once for geopolitical. Labor we did. What about wage? Signs include lower rates of cyclically sensitive wages, indicating job switchers were no longer receiving a premium. That's a bad sign, by the way. Okay. What about, let's go with layoff. Layoffs have been limited so far. That is true. That is actually a good thing. Job layoffs remained low. That is true. That is fortunate. Okay. And then I think really the biggest thing I see here out of all of this is, where's the warning? It's in here. With regard to the outlook for inflation, almost all participants indicated they had greater confidence inflation was moving sustainably towards 2%. Participants cited various factors that were likely to put downward pressure on inflation, like a modest slowing in GDP growth, well-anchored inflation expectations, waning pricing power, increases in productivity. That's actually a good thing, by the way, but that does hurt the labor market. Softening in world commodity prices. Let me see if that's still true. Commodity prices, BCom index. Hold on a sec. Let me get the Bloomberg Commodities Index. Year to date, it started coming down again a little bit. Oh, Bitcoin dropped on that. Bitcoin did not like that. Oh, neither did Nvidia. Well, yeah, because they're actually giving you a warning here. Job switcher. This section right here reads like trash. This is not a good section. Several participants noted while things were in balance, wages were unlikely to cause inflationary issues. Deflationary trends would accelerate. Labor market conditions had eased further in recent months after being overheated in recent years. It's now less tight than it was just before the pandemic. Let's see. Participants highlighted the fact that the unemployment rate had risen notably. Participants, however, noted that labor market conditions remained solid as layoffs had remained, low, basically. Right. I mean, you start getting a jump in layoffs, you got a problem. Labor market indications merited close monitoring. While some noting conditions in the labor market having eased, the risk had increased that the easing could transition to a more serious deterioration. Well, yeah, so they are actually freaking out on the inside that they are close. That's very interesting. Slowing in expenditures, that's not good. Strains on household budgets, delinquencies in credit cards and autos, slowing would likely reduce consumption in the coming periods. Businesses were optimistic but expressing caution, also not good. Participants addressed uncertainties. A couple did not see risks regarding weakening. If they all saw risks of weakening, they would have probably gone 75 cut. Think about that. If all saw weakening, they'd have gone 75 BP. Two didn't. Wow. Wow, that's actually really interesting. Inflation still somewhat elevated. Overall path of policy normalization. It would be more appropriate to determine the degree of policy restriction, basically meeting by meeting. I mean, this is so far pretty generic. This section here, risk management. Almost all agreed the upside risks to inflation had diminished. Where is that? And remarked that the downside risks to employment had increased. Well, yeah. A few participants highlighted the particular costs and challenges in addressing the weakening once it's underway. You could always get inflation back up, but it's very difficult to get jobs back up once they're gone. Once they're gone, they're gone. Yeah, let's do a summary on these pages here because I think this is where the poopy is. Is Powell speaking today? No. Waning pricing power. I see it as a good sign. Kevin, I understand that companies want better pricing power, but overall it could lead to better competition, lower prices, inflation control. If you read any earnings calls, you know there's no inflation problem. The problem with waning pricing power is to create growth, you have to cut. That's the problem. And that means jobs go. Yes, small PP can't hire. You know? So, yeah, not a surprise. You're actually getting a little bit of recovery on bonds here and a little bit of softening in markets there. Not a lot, but this is a more fearful Fed than what we saw during the Fed meeting. So let's do a summary of this, and I'm going to try to be as balanced as possible in this, but it's a little poopy-doopy. Wow, the Federal Reserve minutes just came out, and I have to say, at the Fed meeting, how we got this, like, really hawkish Powell. Remember before the Fed meeting how I predicted, like, if J. Powell gets his 50, he's going to have to hawk. And that's what happened. Now, I wasn't expecting some of the things that ended up happening in the market, but we thought if J. Powell goes 50, he's going to hawk. And he hawked that. I mean, he hawked to us. It was crazy how much he hawked. He's like, everything's fine, the economy's fine, everything's fine. Well, when you actually look under the hood, it's like, oh, damn, this four-cylinder is about to bust. It don't look very good. And I'm going to just restrict this conversation to the most important part of what came out of these Fed minutes, and let's discuss them and talk about pricing power and what's going on here. But it's actually potentially a lot more dire than Jay Powell really let on at the last meeting. And I think it's important to have this discussion of, if they screw this up, it's very difficult to fix. Think about this. You can fix low inflation by printing more money, but you can't get jobs back once they're gone. And folks, that's like the definition of what we just saw in these minutes. These minutes highlight a dovish Fed, not the hawk that we got from J. Powell. Let's go into some of the minutes together and see what we've got here. So this is the section I want to get started in. We already know they're going to be data dependent. All the reports are going to matter, blah, 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 blah. We already know that the last jobs report was basically 785,000 government workers. We already know that in the household seasonally adjusted level. That is 785,000 government workers out of nowhere, out of somehow appearing in payrolls, lowering the unemployment rate with this massive seasonal adjustment. After you remove all the teachers, you still get a 785K boost. That means you actually lost like over 250,000 regular jobs. Yeah, it wasn't a good labor report, although everybody's been cheering about how great the labor report is. Well, listen to the Fed here, because if you go to the Fed minutes, you go to page 7 and on, this is where you're going to see the biggest pain. First, I want you to see some of the things that the Fed is really worried about. First, they see a modest slowing in GDP, but that's just the start. As GDP starts slowing, I understand GDP was hot with estimates in September, but you have to also keep in mind the September pull forward may have been heavily due to the port strikes. Salespeople calling up going, hey, get your order in now before those port strikes shut everything down. Obviously, those are over now. And in fact, when you look at wholesale trade numbers that we got this morning, they were 0.5 percentage point worse than expected. So we got substantially worse wholesale trade numbers this morning, which is somewhat indicative of, yes, we had a pull forward last month, but it ain't going to last with some of the data going forward. And the Fed is keenly aware of this. They see a slowing of real GDP coming. On top of a slowing of a real GDP, they see waning pricing power. And I understand everybody wants deflation. Like, that's the thing. It's like, yay, we want lower prices. But people forget that deflation means businesses can't show growth. When businesses can't show growth, stocks don't go up. So what do businesses do when they can't show growth on the top line? They show growth on the bottom line. They do that hopefully with lower input costs via commodities or producer prices, or they cut jobs. And that's the problem, because even the Fed in these minutes acknowledges that while companies aren't conducting layoffs, they are hiring less. People who are quitting jobs aren't getting the pay premium they used to. And companies are just, well, kind of letting people go via attrition and then not rehiring them when they leave. They're doing more with less. So while it sounds good to have increased productivity, remember, increased productivity is another way of saying we need fewer workers. Waning pricing power means we can only grow EPS through fewer workers. So, I mean, think about this for a moment. In an anchored inflationary expected environment with slowing GDP growth, I'm going to put down arrows for every time it would push jobs down. Slowing GDP growth, jobs down. Waning pricing power, jobs down. I actually think there are very few companies, if any, that actually have pricing power right now. I think it's a pretty precarious time, especially where valuations are. Increases in productivity reduces the demand for labor. A softening in commodity prices, that could be neutral, so we'll leave that one unmarked. Several participants noted that nominal wage growth had continued to slow, with few participants citing that it was set to decline further. That reduces consumption, which starts the cycle of more layoffs. These signs include lower rates of cyclically sensitive wages and data indicating job switchers were no longer receiving the premium over other workers. Some participants noted that wages were a relatively large portion of a business's costs in the service sector, and that service sector deflation would ultimately be assisted by nominal wage growth. In other words, inflation's not the problem. We're probably going to see more disinflation, but that could also come, especially since jobs are a large portion of a business's cost in the service sector, potentially also jobs down. Several participants noted that supply and demand in the labor market was roughly balanced. Wage increases were unlikely to be a source of wage pressures. We've heard Jerome Powell talk about this before. With regard to housing services, some participants suggested we could see more rapid disinflationary trends coming. This basically means more disinflation, less inflationary risks, more labor market risks. The labor market was now less tight than it was just before the pandemic, and some participants stressed that rather than using layoffs to lower labor demand, businesses had instead been taking steps to post fewer job openings, reducing hours, or making use of attrition. That's what we already talked about. Participants observed that the evaluation of labor market developments had been challenging, with increased immigration, revisions to payroll data, and possible changes in the underlying growth rate regarding productivity. In other words, it's kind of like the Fed feels like they're flying in the clouds with no instruments. This is bad. They're basically saying we can't fully trust the data right now. And what we're starting to see is that labor is weakening and inflation's less of a problem. So way less of an inflation problem, way more of a labor problem than Jay Powell led on at his press conference. Now, participants indicated that the baseline is that the labor market would remain solid, but some also argued that once you get labor market easing, the risk that easing could transition to a more serious deterioration increases. And the problem with that is once you start, they say it themselves, once you start having, I can't remember exactly where it was, but basically once you start getting a weakening in the labor market, it's really hard to fix it. Now, they said that business contracts were optimistic about economic outlook, but they were exercising caution. This is something you saw in the Beige Book as well, where they're basically like, we're looking forward to a good Q4, but what if we don't have a good Q4? What if the holiday season sucks? What about these slowing expenditures or these strains on household budgets and delinquencies and credit cards and automobile loans, and the fact that the level of 27 weeks of unemployed workers has been rising substantially, and the only time it rises substantially is in a recession? Right now, the stock market and bond market is only pricing in like a 15% chance of recession. Nobody is properly positioned for a potential recession here. But then again, this time's different. We're going to have a soft landing. A couple participants, however, did not perceive an increased risk of further weakening. These are the people that actually kept the Federal Reserve, in my opinion, from going with a 75 BP cut. I think there's so much stress coming from these Fed officials that most of them are like, no, the upside risks to inflation have diminished, and we've got big problems potentially on labor coming. And a sharper than expected slowing in consumer spending in response to labor market cooling, or because of these lower budgets from lower income households, could make it even harder. It's also, remember, worth always considering that once the labor market weakens, it's a lot harder to fix it. Take a look at this. A few participants highlighted, in particular, the costs and challenges of addressing such weakening in unemployment once it is fully underway. In other words, if you get a Fed here that is blind to the downside risks, they are going to drive us into recession. And even though we got a hawkish Powell, if you actually read that labor report, I wanted to go bullish off of it. But if you actually read that labor report and if you actually look at the data and you go, oh man, table alpha 8 is really bad, private payrolls are falling, government employment up, after having already subtracted out your teachers going back to work. Oh, and then how does that compare to prior Septembers? Oh, well, if you look at prior Septembers, it's really bad. You have non-farm payroll levels, huge adjustment up, while at which is something you haven't seen before, while at the same time, you have the people actually responding to the survey at record lows. These are bad things. Look at the adjustment that you got in the government payrolls right here. You have 3 giant red lines like this. Once in July of 22, December of 22, and once in this last report. You know, hey, you know what? Maybe just ignore it. But to me, it's a red flag, and that is a dovish Fed. And I think right now, the fact that, I mean, it still blows my mind that yields have risen as much as they have, but I think the higher yields go right now, the greater chance of people flirting with recession. I personally am of the mindset that, and this is not personalized financial advice, but my mindset is pay off margin. Please, I don't want to see you go bankrupt from margin, okay? Pay off margin. Think about diversifying. Raise some cash. Raise some cash for a post-election dip or something, okay? But it is okay to take some profits from the Vegas table. Protect yourself. That is a dovish Fed. And if you think that labor report was good, you did not read table A8. Look it up yourself. Type it into Google. BLS labor report. Click on it. Scroll to the bottom. PDF. Click on it. Scroll to page 18. Alpha 8. Then read private payrolls, government payrolls, seasonally adjusted and non-seasonally adjusted. Read both of them. And you will not think that jobs report was good. Good luck, everyone.